Hello, everyone. I'm Patrick Fross with Fross and Fross Wealth Management, and welcome to our market update video for the week of November 10th, 2025. I hope you're doing well. Well, you've probably seen the headlines lately comparing today's AI-driven market to the late 1990s dot-com era. Those comparisons are natural, and they're worth taking seriously. But as always, it's important to step back, add context, and focus on what's actually driving the numbers today and what it all means for your portfolio. Let's start with valuations. Stock prices have climbed, and by simple measures, like price versus earnings, the market does look more expensive than its long-term average. And that's a good reminder for discipline. But at the same time, the market as a whole is still below the most extreme valuation levels we saw in the late 1990s. So while it's not cheap, it's also not the same bubble environment we remember from that era. The biggest difference is that today's leading companies are actually generating profits. Back in 2000, most internet companies weren't earning money at all. Many were burning through cash. In fact, 74% of the 207 publicly traded internet companies had negative cash flows, and at least 51 of those companies were projected to run out of money in the next 12 months. That's a big contrast to what we're seeing today. The Mag 7 companies leading the PE ratios are some of the most profitable companies in history. Today, overall profit margins across U.S. companies remain above their 5-year average. That doesn't mean that there's no risk, but it does mean prices are supported by real business results, not just speculation. And when it comes to artificial intelligence, this isn't just a story. It's real, heavy investment. We're seeing record spending on data centers, chip facilities, and software infrastructure, which is really the plumbing that makes AI possible. That kind of investment often lays the groundwork for future productivity growth, even if short-term enthusiasm tends to run ahead of the data sometimes. And this doesn't mean that the market won't experience a pullback. On average, the market experiences a 5% or more pullback roughly 3 to 4 times per year. Corrections of 10% or more happen on average once per year. When this happens, don't panic. Talk to us, and we will definitely address the volatility as it comes. So what does this all mean for your strategy? Well, we're staying disciplined, monitoring earnings, profit margins, credit conditions, and inflation, and adjusting as the facts change. Our goal is to keep your portfolio positioned for a range of outcomes, both stronger and more challenging. The bottom line is we're on top of this, and we're here to talk if you'd like to discuss how these shifts fit into your long-term plan. So please reach out if you have any questions, and as always, click on the link below for more information. Thanks for watching, and as always, thank you for your trust.